Today, we're going to be talking about navigating mortgages with today's rates. Now, before I get into what's going on right now, I just wanted to cover some of the most commonly used mortgage jargon so that at least we understand the basics of mortgages and the moving parts, because without knowing what those terms mean, it's going to be difficult to understand what's going on with today's mortgage rate. So let's get started. First of all, very simply, what is a mortgage? A mortgage is a loan against the value of a real estate property. So for the most part, most of us will not be buying our homes or any investment properties with cash. So what we're going to do is we'll need a loan, and that loan is called a mortgage. Now, the entire length of the mortgage is called your amortization period. So the most common amortization period for a mortgage in Canada is 25 years. It is, however, possible to go up to 30 or even 35 years, but we'll get into that in a little bit. Now, throughout the amortization period of your mortgage, the terms of your mortgage don't stay the same. Basically, your mortgage is divided up into terms, with the 5-year term being the most commonly used term in Canada. Now, around this time last year, up until now, the 3-year term has become more and more popular, but still the 5-year mortgage, the five-year term is still the most popular type of mortgage in Canada. So in Canada, if you are planning to purchase a property that you're moving into, so an owner-occupied property, if you are putting less than a 20% down payment on the purchase price, you are obligated to pay a mortgage default insurance. So this is an insurance premium that's added onto your mortgage payments, and there are 3 mortgage default insurers in Canada. There's the Canada Mortgage and Housing Corporation, there's Sagen, and there's Canada Guarantee. Oftentimes, people will refer to the mortgage default insurance simply as the CMHC. The CMHC, or the Canada Mortgage and Housing Corporation, do take care of most of the premiums in Canada. However, it's important to know that there are actually 3 mortgage default insurers. If you put less than a 20% down payment, you will have what's known as an insured mortgage. And the maximum amortization period for an insured mortgage is 25 years. If you're purchasing a property and you're putting 20% down payment or more, you will have what's called a conventional mortgage, and you are not obligated to pay this mandatory mortgage default insurance. When you do put 20% or more of a down payment, you will have what's known as a conventional mortgage. Conventional mortgages, you could have an amortization period up to 30 years. It's possible to even go to 35 years. However, the only lenders that offer amortization periods up to 35 years are alternative lenders, where the interest rate is a little bit higher. Now, to understand what's going on right now, a lot of it has to do with the qualifying rate and or the stress test. So what is the stress test? So there is the contract rate that you're offered. The contract rate is the actual mortgage rates that your payments are going to be based on. However, before we get to that point, there's the qualifying rate. The qualifying rate is 2% more than what your contract rate is. So what does that mean? You make an offer on a property, it's accepted, and now you're trying to get the final approval, and you're shopping around for the right lender for your situation. So let's say you go to ABC lender and they're offering you a rate of 5.75%. In order for you to qualify and to get the final approval, that lender needs to qualify you not on 5.75, but on 7.75. So 5.75 plus 2, which is 7.75%. That is the qualifying rate that we as mortgage brokers and mortgage specialists need to qualify clients on when applying for a mortgage. Why? Because this is a federal government rule, and it's to make sure there's a little bit of leeway and to make sure that people who are entering into the real estate world in Canada have a little bit of cushion and are able to make those payments. So this is the primary reason why a lot of people have been kept out of the mortgage market or the home purchasing market over the last year or so, ever since interest rates started going up, because the qualifying rate has gone up. Why has the qualifying rate gone up? Because interest rates have gone up. So a lot of people have been pushed out of the mortgage markets. The Bank of Canada plays a huge role in rates in Canada. So the Bank of Canada is our country's central bank. So the role of the central bank in every developed country has their own central bank. So the role of the Bank of Canada is to control inflation, to control the movements of money, as well as to control the overnight lending rates. So the overnight lending rate is what banks use, the rate that they use to lend money to each other, literally overnight, so that they could balance their books. The Bank of Canada has 8 rate announcements a year. Here in 2023, we have 2 more rate announcements. One is October the 25th, and the last one is December the 6th. These rate announcements directly affect variable rate mortgages only. They do not affect fixed rate mortgages, contrary to popular belief. So when Bank of Canada's rates go up, variable rate mortgages go up as well. When Bank of Canada's rates remain the same, variable rate mortgages tend to stay the same. When rates go down, variable rate mortgages tend to go down. So now, because rates are so high, variable rate mortgages are becoming less and less attractive. But regardless, if you look back in history, the most popular type of mortgage rate in Canada has been the 5-year fixed rate mortgage. So how are fixed rates calculated? Fixed rates, like I said, are not calculated the same way. They do not move the same way as variable rate mortgages. There's a lot of false information out there, and this is absolutely true. So fixed rate mortgages are dependent on the Government of Canada's bond yields. So bonds are basically loans that major corporations and governments issue to investors like you and I when they need to raise capital or get money. In return, they vouch to give you a certain rate of return. Now, if the corporation or the government is a solid country or a solid province or a solid municipality or a solid corporation, this return that they vouch to give you is not guaranteed, but the better quality, the more likely they're going to pay you that interest rate. So when you're talking about Canada, Canada has a pretty stable economy. So if they vouch to give you a certain return, you're probably going to get it, as opposed to other countries. So the fixed rate mortgages are dependent on the Government of Canada's bond yields. Bonds trade just like the stock market. So there's a bond market and a stock market, and their rates go up and down during their regular business hours, just like shares in companies. So fixed rate mortgages are not dependent on Bank of Canada rate announcements. Fixed rate mortgages can actually change anytime, any day, depending on how the Government of Canada's bond yields perform, and more specifically, their 5-year bond yield. So this could change at any time. That's why it's important, if you're looking into a fixed rate mortgage, especially with times right now, it's important to lock in a rate, because at least if you lock in a rate for the next 4 months, even if fixed rates go up, you've locked your rate in. So again, fixed rate and variable rate mortgages, the calculations and how they go up and down are vastly different, but online and even amongst friends, families, coworkers, there's a big misconception that they go up and down the same way. Variable rates, their rates go up and down or remain the same based on the Bank of Canada's rate announcements. Fixed rate mortgages could change at any time without warning, and they tend to follow the Government of Canada's 5-year bond yield. So in this day and age, how do you navigate mortgage rates? Is it a good time to buy? Should I wait? These are the most common questions that I get. If you're looking to buy and it's your first property, or you're looking to buy your own home, you cannot put a price on the home of your dreams. So I always say still go out and look. The busier you are, the luckier you get. It's not as if there are no transactions going on right now. There are. The point is that it's very important to get a mortgage pre-approval to make sure that you know how much you're going to qualify for. And yes, rates are high right now, but eventually they're going to come back down. So you can look at it as the glass is half full type of situation, where maybe it's a good idea to get into the market right now when you find your home, the home of your dreams, because you're paying kind of at premium. So when rates go back down, you could adjust your budget accordingly, and that money that you're saving, you can actually put aside to contribute to a TFSA or an RSP or some other type of liquid investment. Some people have asked, what do I do about my renewal, or should I refinance? If your mortgage is up for renewal, now is the time to shop around. Whoever did your mortgage previously, are they there for you? Are they answering your questions? Are they listening to you? I've heard a lot out there from clients that they find that when it comes to their previous mortgage broker or mortgage specialist, they feel that they're just pushing them aside and not taking the time to answer their questions. Look, this is your money. This is your mortgage on the property that you own and live in. You know, this is your budget. These are your financial circumstances. So you want to make sure that whoever it is that you're working with takes the time to answer those questions so that you make an informed decision. Something that a lot of people are doing right now at the renewal, just to help them out because interest rates are high, they're extending their amortization period. So by extending your amortization period, you're lowering your monthly payments in the time being to help you breathe until mortgage rates kind of stabilize. Going back to the question, should I buy now or should I wait? Again, if you're talking about shopping for your first home, for your dream home, you can't put a price on that. You just need to know if you could afford it. There are still people who are buying, right? You just want to make sure that you get the right pre-approval and you purchase something within your means. If you're looking for an investment property, again, it goes back to the numbers. You have to take a look at the numbers and see if they work. There are still deals out there, but they're not going to crawl into your home. They're not going to fall into your lap. You have to stay active. If you're looking to purchase something and you don't have a realtor, get one. Get a realtor who's going to be able to help you and see what's out there on the market, to see how long a property's been on the market, to see how you can make an offer on the property so that it's advantageous for you. Okay, so when it comes to rates, it's important to work with the people who are going to get you through this moment in time, but it's not impossible. And if you're purchasing your first home, please get a mortgage pre-approval. I've seen it over and over again. People think that rates are just like they were back in 2020, 2021. They aren't. Interest rates have gone up. Your buying power has decreased. So sometimes it's a question of, you know, do you want to look for a condo that's only worth $200,000, or would you rather wait? Or can you still qualify based on your situation and find something that's decent? Look at the numbers, work with someone who's going to answer those tough questions. It's a tough time right now. So as the person you're working with, someone who values your time and will help you on your journey to this new purchase. If your mortgage is up for renewal or you're thinking of refinancing, once again, the person you worked with previously, are they there? Are they answering your questions? Or are they kind of dodging the questions? Another thing to be careful of are really low rates. There are some lenders who are offering much lower rates than are what's on the market. If it's too good to be true, it probably is. And every mortgage lender, every mortgage specialist and every mortgage broker should be able to answer the question, what is my penalty if I need to break this mortgage? And if they're dodging it or if they're giving you the runaround, that's a red flag. In this day and age, in my profession, and when it comes to your money, you have to make sure the person you're working with is transparent and is there. So that's my advice to all of you. I know it's a tough period of time, but it's just a small bump in the road. Make sure you surround yourself with the right people. Make sure you keep an open mind. And yes, it is possible to buy real estate in this market. And yes, we are going to make it through. If you have any questions, feel free to reach out.